So glad you could join us here on a Friday. I'm Marlon Bowling with you to take a look at your ag commodity trade. Well, we're going to put a bow on this week here after today's trading session, but in the meantime, we're going to see how the futures are doing, and we'll bring along a little expert help too. This time around, we're going to visit with Steve Georgy of Allendale Incorporated in McHenry, Illinois. He joins us right now. Steve, haven't had a chance to visit with you for a few days now. Good to have you back with me here on the show as we take a look at our opening trades on the grain. Let's dive into it. We had the export sales numbers that came out earlier today, and now we can see how the market is reacting. Here's a look at our corn market right now. Higher trade across the board, 3 1/4 higher on July. That puts it at 373 3/4, within a penny of our high of the overnight and early morning trade. December corn now 3 higher at 392 1/4, within 2 ticks of its high of the range. And if you look at the soybean trade this morning, the soybean market has July now trading 10 3/4 higher at 923. How about that? Within a penny of its high of the day. That's now 12 cents off of our earlier low from last night. November up 8 1/2 at 926 1/4. So I'll stop there on the corn and soybeans. Get your thoughts here, Steve, on what you're seeing happening in this trade here today.
Yeah, you know what you're getting is you're getting this feeling now that we're in June. And so you've got kind of a different attitude going on now. These funds are short, corn, beans, and wheat. You are finding a little bit of a recovery because there is a point with soybeans. We'll take that, for instance, because it is up quite a bit this morning. But when you look at that, there's a point where we stop caring about acreage and we start looking toward what kind of yield potential can we see. There is enough weather stories out there talking heat, talking dry, in order to maybe change the way guys think, where it's not so much that something has to change to be really bullish, it's that something has to change to be less bearish in order to shake some of these guys out of these positions. And I think that's what we're getting right now. We could see a bigger rally for corn if we start to see this shaking a little bit more as we move forward with good excellent ratings.
If you look at the December corn to the November new crop soybean ratio, that's only running like, what, 2.3 to 1. That's kind of historically narrow, isn't it?
It is, yes. Well, when you look at the trading ranges that we've had for this entire year, corn has traded in just over a 25-cent range for the entire year. That's light. We haven't done anything in corn. And beans, well, it's rather light too, just over 90 cents, a little better than 90 cents there for the entire year. So, yes, we are going to see some excitement as we move forward. Will we get this kind of weather scare or weather market as we go into the next couple months?
Well, let's look at the wheat now with harvest underway in the southern plains. And, of course, the heat is building. It usually does this time of year. It kind of goes along with the approach of the wheat harvest. The wheat is a little higher today. July Chicago wheat up 3 1/2 at 432 1/2. Kansas City wheat, we have July over there now trading at 435 1/4. Well, now that's up 4 1/2. And Minneapolis wheat had surged ahead yesterday, and today they're adding another 8 1/4 cents on July at 587. So with the wheat harvest coming up, why is the market rallying?
Yeah, it's what we've done here early this week. We saw a drastic setback, too. I think we're just finding a lot of back and forth out of the wheat. We missed a tender from Egypt earlier this week. They were looking for wheat. The problem that we have, no matter what kind of conditions we get here for the U.S., is that the globe still has a lot of wheat. And so until we can find stronger demand for wheat, this market really is probably going to stay in this very choppy market, at least for the time being, until we find another sense of what's next.
Okay, I'll bring you back here in a little bit, Steve, and we'll talk about some of the other markets, livestock and cotton markets as well. I want to get your thoughts on the crude oil, too, if you don't mind.
Sure.
Big move today, so we'll come back and we'll have more with Steve Georgy in just a moment. Come on back. We'll have a lot more to talk about. By the way, I wanted to mention in the export sales numbers that came out this morning, some of the best numbers were actually in that wheat. So that, of course, would be another supportive factor there. Let's take a look at our cotton market before we get into our livestock trade. And in the cotton, we have July down 53 points at 77.10. Your new crop December contract is down 19 at 73.31. I wanted to point out the crude oil market really had a nosedive this morning. It was down well over $1. Well, it's rebounding significantly now, but still sharply lower. July West Texas crude down 79 cents at 47.57. And if you look at the U.S. dollar index value, we now have the June contract down 400 points today at 96.750. Let's go back to Steve Georgy of Allendale Incorporated in McHenry, Illinois, and get his thoughts on this outside market stuff. The dollar down 400 points, typically that would bring in a little extra export business, wouldn't it?
It should, yes. And that's the idea, is that when the dollar does break, that should invite commodities to find some support. We're seeing some of that in the grain markets, but, with the dollar being down, we do have some support just below the market here again today. The thing to be careful on for the dollar is that there is a very strong possibility that we will get an interest rate hike this month. And so with that said, that typically is friendly for the dollar when that happens. And we could find some support from these levels from the dollar, but I don't find a lot of excitement from the dollar. But the thing is that with the dollar being down 40 cents today, you start looking at, why is crude oil down as much as it is? We do have rig counts that come out later on today. We've seen those climbing, but we've seen stocks week after week tighter and tighter. We still have a big supply of crude oil, and we're still in a big sideways range. $44 is going to be a tough support area for that crude, at least for the time being. And anything over $50, we've been seeing some selling as well. So that's about the range we have for crude oil.
So you bring up an intriguing point. We're going to talk about cattle here, and you were talking about a possible interest rate hike. Cattle yesterday, on live cattle and feeder cattle, they all closed limit up on the first 3 contract months. And right now we're trading mixed. We're not seeing a lot of follow through. The nearby June is up $1.49 on live cattle, so that puts it at $128.92. Still well under the cash cattle trade that was established in the mid 130s yesterday. August up 22 at $124.92. Deferreds are actually 60 to 80 lower. Feeder cattle side, as we switch over there, we have the August down 13 at $156.95. September down 14 now at $156.18. Remember, expanded limits in effect here today. But Steve, if we see increasing interest rates, does that mean fewer steaks will be sold?
Well, the idea is that could be the case. I think we have a different problem at hand right now for cattle, is that much like when the April contract went off the board, you had a lot of packers that were just bidding up for cattle. That cash market yesterday, I think, surprised a lot of people, and that's why we did stay limit up. That June, you have June options that go off the board today, and first notice day for the June contract is actually on Monday. So there will be no limits for June. After that, we should follow that cash market for the June contract. But, are we going to see that excitement of the packer just saying, hey, I just need cattle, I don't care, buy it, like we saw in April? Will we see that excitement again? I don't know. But those issues are going to be front and center as we get into next week, as these June options now can't protect the futures.
Wow, that will be an interesting spectator sport if the June goes without limits next week. All right, thanks for pointing that out. I appreciate that. A quick look at our lean hog trade. Right now in the futures, a mixed bag. We have June currently 20 higher at 81.12. July, though, down 27 at 81.85. August down 42 at 81.58. They're all over $81, though. So keep that in mind. Steve, thank you so much. Good to visit with you again. Steve Georgy of Allendale Incorporated in McHenry, Illinois. What a great resource to talk to.
Great analysis there. Okay, thank you so much, Markets Editor Marlon Bowling.